Yellen in her testimony to the Congress, where she voiced concerns about the economic recovery. She also hinted that the central bank may have to review its policy. That was mostly responsible for sending markets into a complete tailspin. For more on that, and to make sense of what the current economic turmoil would mean and the road ahead, I'm now joined by Kevin Cummins, the chief economist at RBS. Thank you very much, Kevin, for joining us here on The Big Picture. You know, yesterday when Janet Yellen was speaking in front of the House, there was a marked change in her tone and tenor. The sense we got that she seemed a lot more pessimistic, especially when she started talking about the financial conditions not perhaps being supportive of growth. What do you make of it?
Yeah, I mean, I think the takeaway, I think, right after the actual testimony was released prior to her testifying before the Congress, I think she struck a pretty even balance between expressing concern about the global economy and tightening in financial developments while still reiterating the Fed's base case that, you know, they're still seeing ongoing improvement in the economy, and that they expect a gradual pace of tightening over time. So I don't think there was really there was not much of a new signal relative to the January 27th FOMC statement, although I guess there was enough focus on some of the downside risk now that it may take the possibility for them to tighten in March seem less likely.
Mm-hmm. Yeah, in fact, you know, when the new year began, we saw the sort of, we saw a lot of turmoil in the global markets, and many thought that that would force Janet Yellen to sort of review her position as far as rate hikes were concerned. Going back, what we've seen over the last month and a half or so, do you think there is going to be a reassessment on the part of Janet Yellen?
Well, I think they're constantly reassessing the outlook, and I think that they did that at the January meeting, and they've done that ever since. In the past couple of months, really, quite frankly, over the past 6 months or so, with all the turmoil in markets in the past few months. So I think that's something that they're constantly, their views are evolving as they get new data. But I think she still continued to think that, at least the background of the U.S. economy, at least the domestic economy, is still in decent enough shape. And she talked positively about all the developments, and particularly in the labor market. But, right now, given the uncertainty, and as she mentioned, there's always uncertainty in the outlook, but especially with what's going on in around the world, that could potentially change their view of things. So they, at the January FOMC meeting, basically abandoned their risk assessment. And yesterday's testimony kind of reiterated that there is a lot of uncertainty, and I think that does probably lessen the chance that they are anxious to raise rates as soon as, say, March. But it doesn't necessarily change their outlook for later in the year of, continuing down the path of normalization.
Right. Because many would say
the approach.
Right. Because many would say, Kevin, that because of the current instability, it's also putting a lot of upward pressure on the dollar, thereby making U.S. exports not so competitive. As far as that is concerned, how will Janet Yellen weigh in on that as far as the currency volatility is concerned?
Yeah, I mean, that's a direct subtraction and a direct effect of the stronger dollar has directly affected export growth. So we've seen, that's something that really has dragged on the U.S. economy, and quite frankly, it's spilled over to the manufacturing sector through much of the past year or so. In addition, oil prices have been a net drag on the various business non-investment side of GDP here in the U.S. So if that were to persist, then they probably feel the need that they're going to have to mark down their view, and that would be consistent with the idea of less aggressive of a path for higher rates. Not that their path is very aggressive at all. It's obviously a pretty gradual rate hike guidance that they provided in December, in just a month ago, in December. But nevertheless, if things are starting to spill over to the broader economy, then they would probably remove some of the actual increases in the Fed funds rate that they expected at the end of last year to happen this year.
Right. Final word then, Kevin, like you mentioned in the context of Janet Yellen, where she did speak about the labor market. So let's just, if we were to stick to the labor market just for a brief moment, because in January we saw the unemployment rate falling to 4.9%, which is considerably lower than 5.7% as it was in January 2015. So, a word on that? I mean, since you're tracking the U.S. economy, is there genuinely, are we seeing an uptick?
Yeah, I mean, the conditions in the labor market are still very solid, and that's what's, so far the conditions in the U.S. labor market have driven monetary policy. Obviously, the Fed is watching inflation, but so far, given the drop in the unemployment rate that you've talked about and the still solid pace of job growth, I mean, if you look at overall non-farm payrolls from last Friday, you were up 151,000 in the month of January, and obviously that's a bit of a slowdown from where you averaged 279,000 jobs a month in the fourth quarter. But the way we see it is that jobs report was even stronger than kind of we expected. It came in line with our headline number. But, I think the slowing that we saw, we think is more of indicative of some temporary factors. For example, at the end of the year, we saw a build-up in temp jobs ahead of the holiday shopping season. And so temp jobs added 25,000 in December, then they subtracted 25,000 in January. So you had a swing of 50,000 jobs there. Another area that suggested it may be just temporary, I wouldn't necessarily extrapolate the weakness, was in the education component. That fell almost 40,000. That was the largest jobs loss on record for that particular industry. And that's probably more indicative of faulty seasonal factors. The work week, which usually does slow if things are starting to spill over for labor demand, that actually picked up. You mentioned the jobless rate was down another tenth. Employment in the household survey was up 409,000. So the reason I'm
right. So overall, we are seeing some sort of an uptick. Right. So overall, we are seeing some amount of uptick then. Well, thank you very much there, Kevin, for joining us here on The Big Picture and really helping us making sense of this global market turmoil, which at this point of time is mostly perhaps emanating from the US. Thanks very much for joining us. Well, it's time for a